Hey guys, welcome aboard. I'm just gonna, hey everyone. I feel like coming on live tonight. I enjoy everything, everyone. See if anyone joins us here this evening. I like going live. I like talking to folks. I like seeing what's going on out there, seeing who's out in the YouTube world. I'm certainly not competing with Game of Thrones tonight because I know Game of Thrones was on the other day and that had like 1 billion viewers. Didn't do anything for me, but figured I'd jump on board and see who wants to join me. So just let us know where you're coming from, and appreciate y'all being here for sure. I got a couple of things we'll share with you. Let me look at some of my questions I've been getting on the email. If I can get my thing to work up here. I had a guy, Roy from Ohio, email me earlier today about the Larry Kotlikoff Maximize My Social Security website, which is a wonderful for any of you all who are interested in Social Security planning. It's going to be hard to beat Larry Kotlikoff's Maximize My Social Security .com software that he has. I would show it to you, but I'm not sure how to actually, I don't know how to do this. Yeah, I'm not sure how to do this here live, but Larry Kotlikoff on MaximizeMySocialSecurity.com, man, fantastic. Then you go to my man Jaeoh at MaximizeYourMedicare.com. So you got Kotlikoff, Maximize My Social Security, and Jaeoh, MaximizeYourMedicare.com. Just two great models for you to dive into in terms of Medicare planning and Social Security as well. Kotlikoff, his software is $40, man. $40 for a family, I think a year. Man, it's the best deal in town without question. I'm thinking about this. We got the pollen here. I'm gonna sneeze. Hold on. Man, we got pollen like crazy here in North Georgia. It's like freaking a quarter inch on my back porch. It's nuts. Ugh. All right, so Kotlikoff is MaximizeMySocialSecurity.com website. It's $40 for the year, and he's got the consumption smoothing thing. And I cannot stress how much the consumption smoothing works. And what I'm just telling you, for any of you all who are new on board here, here's how it works for me. All right, I got 4 kids. One's in college. We got 3 of the braces, glasses. We got sports. We got graduation. We got everything coming out to Sunday for expenses. So our expenses are here because my wife and I have 4 kids plus a mortgage. 4 kids, mortgage. All right. That's where we are right now. Where do you think our expenses will be in the future? Will they be up here? No, they're going to be down here because hopefully the mortgage is paid off and the kids are self-sufficient. And that's called consumption smoothing. So what Kotlikoff would say is, look, everyone is trying to save all their money when up here. All right. Why do that? Why? I mean, you're up here. You don't have enough disposable income in which to save all that money. You don't. So everyone's going to get frustrated. Like, I'm making $100,000 a year. I should be putting 10 to 15% away in, but I can't. I can't afford it. Well, no wonder why. Because you got the freaking 4 kids and a mortgage. How are you going to be able to afford that? It's like, oh, I can never retire. Well, guess what? At some point, the mortgage is going to be paid off. And when the mortgage is paid off, you don't have that expense. And then the kids are out of the house. You don't have that expense. So you downsize. And that's why your consumption drops, because you no longer have the kids. It's nuts, man. Everybody hear me okay? Give me a thumbs up. Hey, from Louisiana. Right on, Michael. I just saw you had posted something on one of my YouTube videos today, so I responded to that, by the way. But anyway, so here you got so everyone's like, man, what? I can't retire because blah, blah, blah. And that's what I did touch on a sore spot with the industry in my video on advisors charging fee-based accounts. What's going on, June, from Massachusetts? Where in Massachusetts, June, are you from? Jim, my lefty buddy. Right on, Jim. Brian Marcus. Okay. Jim, where are you coming from, my friend? We got a couple of resident liberals on the YouTube channel. It's quite fine, man. Quite fine. But South Boston. Okay. Right on, June. June C. Maui. Right on. Oregon. All right. Maui and Hawaii. Okay. All right. Oregon. Okay. Oregon in the house. Thanks for answering my email on pensions. I hope that helped, Jeff. Absolutely, sir. That's you're never. I'm telling you, man. If you're married, filing jointly, take advantage of those 2 tax deductions, I guess they are tax deductions, standard deductions for sure. But anyway, so I did want to real quick go back to this because I find the Larry Kotlikoff stuff on consumption smoothing really made a difference in my own financial planning, because I was always under the assumption if I'm making $100,000 a year and I need a plan as if I'm going to need that, some model of that, say 80% of that when I'm retired. It just Kotlikoff's book, and I got it back there. I spent till the end, I think. I got it back there someplace. But anyway, all of a sudden it made sense. He's like, look, you're not going to spend that much. You're not going to spend $100,000 like you would when you have the 4 kids. And I just, for me, is fundamental for sure. And I just hope that you guys recognize too that when you hear some of these financial planners, financial advisors using their boilerplate crap, and this is, I see, going back to my video I did. By all means, throw questions out there. I'm going to yap. I got some things to say, but if you have questions, thoughts, concerns, I'm just doing this out of the nowhere. So Jeff says, what do you think about Kotlikoff's Maxify Planner? Love it. Absolutely love it. The one drawback about it is because I was looking at, Jeff, I was looking at the software I use through Right Capital versus Kotlikoff stuff. And I went to Right Capital because I had the 1040s, and I love the 1040s. Kotlikoff was good. It just didn't have the 1040s on there. Kotlikoff, I interviewed him for my podcast about a year ago now. And you know, he's a good guy. I mean, he's freaking out there on the left. I'm telling you, he's certainly not a fan of the Trumpster. I'll tell you that right now. But he recognizes the need to get some sanity in government in terms of our spending, without question. He recognizes that need. And so he ran as president in 2012 and 2016. Everyone thinks he's kind of like a gadfly. No, he's saying, look, we have $100 trillion of unfunded liabilities. We're going to have to pay for this somehow. And you know, one of his proposals is increasing taxes. I mean, that's if you want it, someone's got to pay for it. And Naples, Florida, right on, man. PC. And so Kotlikoff, I mean, he's one of the straight shooters without question, and I loved it. And his software is fantastic. His books are fantastic. And again, he's a guy who was able to get the OIG, Office of Inspector General, from the Social Security Administration to pull their heads out of their butts at the SSA to recognize what they're doing with widows. Nothing's changed. I had an email from a lady just the other day who said she went down there and they were like, "Ooh, you know, you don't get this or that." And she's like, "What? That's crazy talk." And the people at Social Security were wrong. It was my friend. I said, "Look, when you go down there, friend, just beware. They're going to tell you some bad info." And sure as hell they did. And that's freaking, how many, I mean, it just is nuts. And this is after we know that the OIG, Office of Inspector General, told Social Security that they had left $127 million on the table for widows who actually qualify for that. But because of crappy advice, they didn't get it. And the Social Security is just like, Right Capital is not available for consumers. So Maxify is more affordable. I agree with that 100%. Maxify is great. For me, as a financial professional, financial planner, I like the Right Capital for sure. But if I'm just running my own numbers, I'm using Kotlikoff stuff without question. Someone had mentioned eMoney. I forgot who it was. eMoney is pretty good. Fidelity gives it to you for free. That's eMoney is fantastic. Yeah, it's better than Right Capital. In terms of its, what's the word I'm looking for? It's just got more stuff in there, especially when it comes to estate planning stuff. It's been a year since I used eMoney. I'm sure it's gotten better, but eMoney is the best in the business. It doesn't show, at least it didn't show the 1040s, and Fidelity bought eMoney, and I thought it was wonderful. So if you have access to Fidelity, you should have access to the eMoney software for free, is my understanding, and it's good. It's from a estate tax, from an income tax perspective, from just your estate planning perspective. Can I buy you $1? Okay. So from the estate, you got it, Mark. Thanks, man. So from a estate planning perspective, eMoney is the best in the business without question. But it didn't have the 1040s. I love looking at the 1040s because it gives you the breakdown, that line item by line item. 401k at 60-40 stock bond convert to a Roth. Do you keep the bonds? No, if I got my Roth, man, I don't think you should have any bonds in the Roth. It's just, that's all there is to it. So then people say, but then I have all stocks. Well, yeah, that's, all right, I have to get rid of this guy. All right, so let me get rid of this guy here real quick. Hold on just a second, my friends. Remove. Okay. All right, so we just got rid of our man alligator. I don't know why people got to be stupid. Weird. All right. So what happens is when you start converting into your Roth, and essentially you'll have, going back to the 2 buckets of money, you're going to have a bucket of cash and a bucket of stocks, and that's it. And the bucket of cash would be CDs. So you're going to have your Roth with all stocks and your cash and CDs, or short-term bonds is fine. I'm not, if you have bonds, I'm not going to jump up and down and scream and holler. In fact, I'm going to show you, I'm getting ready to do a video on this, paper from my man Meb. Right here. This is so you can see here on this chart, this is the max drawdown for stocks, the max drawdown for bonds. So I'm not sitting here saying bonds will make you an evil person if you own them. But you can see the red, it's hard to see, but see that red right there. This is the max drawdown for bonds. Just bonds don't have the downside volatility. They just don't. And that's one of the benefits of them for sure. But you can see the max drawdown for stocks. You see what I'm saying? So if you would just look here, 1, 2, 3, 4. Wait, let me go back. 1, 2, 3, 4, 5, 6, 7, 8, 9. 10. I mean, we got multiple declines on there. Just multiple stock declines, and we just don't have that in bonds. But I just, that's why you keep enough. That's why you keep enough in cash. So when the stocks go crazy, you have enough cash to right the ship, if that makes sense. Offhand, you know the Fed tax brackets for 2020. Trying to help my single girlfriend retiring this year with PERS and trying to figure out her IAP. I don't know what IAP is. Rollover then conversion of 4 chunks by age of 70. We don't know yet, Jim, because they haven't issued they haven't talked about the inflation adjustments. But I mean, at the end of the day, if she's single and she has, let's see, we got our tax planning guide here. So if she's single and she's right now, her taxable income for a single person in 2019, 0 to 9,700 is in the 10%, 9,700 to roughly 40,000 is in the 12%. So I mean, you probably go up by $1,000. So 0 to 10,500 be 10, 10,500 to 40,500 be 12. 40,000 to 85,000 be 22. I think I'd be pretty safe in saying that. Bruce Smith, my man Bruce is on here. What's up, Bruce? Are bonds really that bad for a 62-year-old retiree? I mean, I just think you got to divide your assets into growth versus income. And your income, again, in my opinion, should be you just have your income covered in CDs. And the reason for that is because they mature faster. They're paying the same yield as a bond is right now. And they're FDIC insured, where bonds, I mean, corporate bonds, there's no insurance whatsoever. And so if I'm getting risk versus risk, a CD will give me exactly almost the same thing as a bond will, with less maturity date before it comes matured. And on top of that, 100% explicit FDIC. I mean, you're talking about a 10-year Treasury right now. It seems like every time I do this on this live stream, the numbers are roughly the same. 2.592 is on that 10-year Treasury. 2.59. See, there it says TNX. I don't know if y'all can see that. 2.592. I'm not sure if that shows up or not. That's a 10-year yield. You buy a 10-year Treasury today, you're locking up your money for 10 years and getting 2.592, 100% taxes, ordinary income. So there's no value there relative to a CD, which is FDIC insured. Now, a Treasury bond is the least risky investment there is. I get that. But you're still locking up your money for 10 years. So I just say, screw the bonds, just put in CDs, whatever you need. 3 years, 5 years, something like that. Do ladder CDs, 1, 2, 3, 4, 5. It's a pretty good portfolio, man. Pretty good portfolio. And the rest in stocks. Way to do it. Let's see. Are you a fiduciary? Okay, hold on a second. Learn so much, listen to your videos. I am a fiduciary, but I could care two craps about that terminology, Joe. And the reason for that is because fiduciaries who charge 1.5%, in terms of their assets under management, I don't know how you can. I don't get it. I mean, I just don't get it. I had a couple guys, I hit a sore spot with some financial advisor saying, hey, why you charge $2,500? Why don't you charge $500? I said, because I feel like it. Charge $2,500. People don't have to pay. And their argument was right. It said people don't have to pay a financial or 1% asset under management fee. I said, no, I get that. But the problem is very few people do pay that fee. Very few people do. So they're hitting up a tiny segment of society, and you got this huge segment of society who actually needs financial planning help. So all these fiduciaries out there saying they're holier than thou, only helping a tiny little subset of our population, pisses me off. Not going to lie to you. Marlton, New Jersey, right on. And so going back to that, I'm not a fiduciary, but again, what does that mean anymore? Oh, I don't sell investment. And I hate this. See, it's just so trite. Oh, we do this evidence-based investing using dimensional fund advisor stuff. We got these Nobel laureates on our board. And look, French and Fama, I like them. Eugene French and Ken French and Gene Fama. Look, I like their studies. I like their factor investing, value, small cap. I mean, I believe in it. But evidence-based investing tries to make investing a science. It's freaking not a science. It's emotions. 100%. There's no science in evidence. I mean, that's why you have the Wall Street Journal used to do these stock charts where they take monkeys throwing darts up against the board. And half the time, the monkeys would do better than the highest paid Wall Street analysts there were, just because it's completely random, completely luck. That's why Burton Malkiel wrote Random Walk Down Wall Street, because it's random. We don't know. There's always going to be somebody who outperforms, always going to be someone who underperforms. Who those people are, we have no clue, none whatsoever, because it's random. If it's random, why try to beat something that's completely random, is completely speculative? Why not just match the whole thing, i.e. the index fund? So when a fiduciary says, oh, I only do what does a fiduciary says? I only do what I would recommend myself to. I can't remember what the terminology is anymore, and I just don't care. Would you really pay 1.5%, 1%? I mean, would you do that? Come on, man. It wouldn't. And so on top of that, what's wrong? What's wrong with that fiduciary who's charging 1 to 1.5%? Versus an Ed Jones guy who gets paid a commission where he gets charges 2.5% front end commission and 25 basis points every year thereafter. Who's looking out better for the consumer? And it's not the guy charging 1 to 1.5%. It's just not. It's the Ed Jones guy. At least you know with the Ed Jones guy going in, you're not going to get real financial planning. But all these guys out there hold themselves as real financial planners. I guarantee you the vast majority don't. They don't. They do investment management. And I got no problem with that. But don't hold yourself as doing comprehensive financial planning because you're a fiduciary if you're not freaking doing it. And don't just give me some stupid Monte Carlo like they do over Vanguard. Look, I love Vanguard. It's fine. But they give you these Monte Carlo analysis as if that's real financial planning. It's not. Real financial planning is getting the nuts and bolts of what's going on cash flow, the tax consequences, looking at Social Security, looking at the Roth conversions. You got me going on. All right, so let's see. My man Bruce is in the house. Share E. When you start taking withdrawals at 7.5, do you have to take a percentage from each account, or you can all from one account? That's a great question. All right. So that's all right. So Sherry, I'm just Share E. I can't tell you if you got. All right. So you got 4 different IRA accounts like that. All right. So let's say 25,000 in each. All right. 25, 25, and 25. All right. So you got 4 different IRA accounts, 25,000 each. You can aggregate them and say, I got $100,000 total. All right. Because 1, 2, 3, 4, that's $100,000 total. And I divide that by 27.4 because I'm 70.5. So it's going to be about $3,700 you got to take out that first year. You can take it out from one. All right. So you can say, look, in the aggregate, I got these 4 IRAs. My RMD, it has to come out. The IRS, they don't care from where it comes out as long as it comes out. And so I have to have $3,700 of taxable income, either in the aggregate or prorated. They don't care. Now, when it comes to 401ks, though, it's different. Each 401k has its own mandatory distribution. Thus, it's never a bad idea to just kind of consolidate 401ks into one, or at that point, roll to an IRA. I do want to say, I talked to a lady today. She had an account over at with her local bank paying 1%. She was paying a 1% fee, and I have no clue how she's invested. So she's probably paying another 1% on top of that because of mutual funds or whatever in there. She's going to retire in 2 years. She's a little bit nervous about the market. I said, and we're just talking. And she goes, I could tell she just wanted to get out of the. Let me get rid of my email there. Krakow. Oops. All right. Oops. Back on here. So I said, look, you're going to retire in the next year because that's what we came up with our financial planning. Just roll that money that you had in your IRA at the bank, just roll it over to your Fidelity 403B account because she had a guaranteed minimum of 2% on a stable value fund. And so what happens here, she said she could do that. A lot of times you can. And so she's going to roll it. She's going to roll that to her 403B, leave it in there at 2%, knowing full well that she's not going to make much money. But I'm telling you, that 2-year time frame right there is so critically important. We cannot have her falling off a cliff like what happened in 2000, 2001, and 2, and then again in 2007 to 2008. And so for her, I'm like, look, she's going to be fine, but just roll it to a 403B, get the 2%, lock in that money, and have it safe rather than sorry. And that's not a bad move. So going back to you, Sherry, it's not a bad idea, instead of having all these IRAs around, if you're still employed, to just consolidate them into one, or to consolidate in your 401k or 403b if you can. I hope that makes sense. I know it's kind of off the topic. My man Marlton is in. Okay, have Ginnie Mae instead of cash. Man, Steve says he's got Ginnie Mae instead of cash. I've always been a big fan of Ginnie Mae, as I've shared this story many a time, and some of y'all might be new. I'll never forget when I started working at Vanguard in 1998. Ginnie Mae was paying about 6 1/4. Ginnie Mae is a government National Mortgage Association. And you can go to GinnieMae.gov, GINNIE May.gov. You go to GinnieMae.gov. That's a government National Mortgage Association. The house I'm sitting in here right now, the VA loan bought this house for me, or at least I did, but through the VA. Guess who backs the VA loans? It's the Ginnie Mae, Government National Mortgage Association. It's 100% guaranteed federally government insured bonds, just like a Treasury bond, without question. So Ginnie Mae's are great. Anyway, back in 1998, they were paying 6 1/4 or something like that. And I just remember thinking, man, my goal is to have $1 million, dump it all into Ginnie Mae when I was 65 years old or whatever, and live off the interest. It's not paying 6 1/4. They're paying like 2.5. And the nice thing about Ginnie Mae, though, the bonds, so Vanguard's is VFIIX. And the nice thing about the Ginnie Mae is that there is hardly any volatility. I mean, if you look historically, the Vanguard's been around since 1980. I think they had one down year in like 2015. But the reason it's government guaranteed is because you can. What happened in 2008? Everything got hammered. Everything. There's high correlation to the negative in 2008. Everything got smoked except government bonds. So everything was going down, and Ginnie Mae and other government bonds are going up. And so in 2008, the Ginnie Mae at Vanguard was up like 7 1/4. Everything else, bonds, municipal, everything else was getting smoked. Everything. Except for Ginnie Mae and government bonds. And so people say, well, Ginnie Mae sounds like Fannie Mae and Freddie Mac. No, not at all. Fannie Mae and Freddie Mac in that stage, they should have went just kaput, but unfortunately Bush bailed them out. Stupid, but it is what it is. Ginnie Mae did not have anything like that happen because 100% government guaranteed bonds. So Ginnie Mae did incredibly well in 2008. And that's going back to the issue about having bonds. The facts are, bonds, when the market gets crushed, there is always a flight to quality, flight to safety, and government bonds will provide that. There's no getting around that. Anytime there's a negative tsunami happening in the market, government bonds always hold true because that is the safest investment there is, which is always why I just want to yap on this a little bit. All these people on YouTube, the dollar is going to crash. I mean, people on my kind of side of the political aisle, I'm like, would you stop with this? The dollar is going to crash. And the first thing I do is I say, if the dollar is going to crash, then why is the TNX, the 10-year Treasury bond, trading at such a low yield? The low yield means that's a high price. The high price is because of high demand. All right. So lower the yield, the higher the price. Lower the yield, the higher the price. High price means high demand. If the government was crashing and the dollar was going to crash to zero, then why in God's name would the freaking Ginnie Mae or the 10-year Treasury bond be trading at such high premiums? It doesn't make any sense. And that's the argument I'd never get. Like, okay, the dollar is going to crash. What's the alternative? And you never hear it. Bitcoin's not the alternative. Come on. The gold bars, that's not the alternative. I mean, what's the alternative to the dollar? And there is not an alternative. That's the issue right here is you say, okay, the dollar's going to crash. We should be careful. The dollar's going to crash. We're all going to hell because of whatever the dollar. Did you see what happened in Paris, France as a sign of the collapse of Western civilization? If the dollar's going to crash, then why is the 10-year Treasury trading at such a premium? All right, let me get off that little thing there. Too much, 36, too much cash, start taxable or put more than 10% into TSP. You already maxed the Roth IRA or the Roth TSP, my man Quincy. If you haven't maxed the Roth TSP, there's your answer, brother. Maximize the Roth TSP. Absolutely. June, my 401k is with Fidelity. My husband has multiple. Fidelity, Vanguard, Schwab. Should we combine in one group? I have recommendations. Those are my three favorites. I would have used to throw June. I'd used to throw USA in there, but USA is just they're getting out of that whole business anymore. So USA is no longer in there. Those are the big three: Fidelity, Vanguard, and Schwab. Look, I like Vanguard best by preference. Vanguard is owned by its investors. Fidelity is owned by the Johnson family, who are worth billions and billions of dollars. John Bogle, RIP, was never worth billions and billions of dollars, who founded and was basically the brains behind Vanguard because it's an investor-owned company. So the Johnson family's net worth, John Bogle's net worth, because it was owned by the investors. Schwab is publicly traded. Thus, what do you think the public shareholders want? They want maximized value to the shareholders, which could be at the expense of you. So for me, I go to Vanguard. Fidelity and Schwab both have offices that you can go talk to somebody. And that sounds good, but I'm just telling you, it's like these free portfolio reviews. What do you think they're going to do anytime you get a free review? But they're always going to tell you how crappy your stuff is and how their stuff's going to be better. It's just the way, it's the nature of the beast, man. I got no problem with that. That's how they get paid. Fidelity, I don't know. I know Schwab does. I don't know if Fidelity does. I think it does. They have these third-party money managers, separately managed accounts that the SMAs that they use, and they get paid a fee to put you into third-party money managers. It's just the way the business is. They say you come down there and they say, look, we got this SMA separately managed account. It's the small cap fund of the day. What happens is now Schwab's going to take a cut. Fidelity's going to take a cut. The small cap money manager is taking a cut. I mean, it's just the fees on top of fees on top. It's just the way it is. And I don't like that. Now, this is what I tell people. Schwab's stuff is pretty stout for research and all that. They're offering, I think even Fidelity now is fee-free ETFs. Look, the fees are so low anymore. You're talking 4 basis points of Vanguard. I mean, it's literally nothing. In fact, a guy I posted on, a young guy on YouTube today, was talking about should he buy the Vanguard ETF or the Vanguard mutual fund. I think it's like 7 basis points more expensive for the mutual fund or something like that. I said, dude, it's so cheap anymore. It's not even, just don't sweat it. It's just the days of getting the prices down has happened. We are here now at basically, we're sweeping the barrels here of the low fees. It doesn't matter. So my preference is Vanguard. I say 80 times out of 100. If you need someone to talk to, you're not going to get a Vanguard. You're just not. If you need someone to talk to, my preference, frankly, would be find someone from the Garrett Financial Planning Network and pay a fee. They charge, $100 an hour, $250 an hour, something like that. Just pay someone to charge by the hour. XY Planning Network. I have my pros and cons with XY Planning Network. There's many of people affiliated with XYPN that you can charge. They'll pay an hourly fee and maybe a monthly retainer. I'm all about that. My thing with XY Planning Network, why I got rid of them and I don't affiliate anymore with them, is simply because I don't manage money. I don't want to. And they took a turn to the left. Let's just put it that way. That's actually quite problematic to me. But that doesn't mean all the I know a bunch of advisors who are through XY Planning Network who are not going way safe spaces and trigger warnings and stuff. So I don't hold the advisors in XY Planning Network accountable for the corporate decisions of XY Planning Network. But be it as it may, I no longer affiliate with XY Planning Network. But mostly is because I don't manage money. I don't want to. Garrett Financial Planning Network, though, find somebody, charged by the hour, like I said, $250 to review your stuff, to have a good conversation about everything. That's the way to go. Well, hell, I'll charge you. I charge $2,500 for a full-fledged financial plan. like I was talking later today, once every couple of years, you're golden, man. We don't have to reinvent the wheel, but the initial part of financial planning is always the most user intensive. And after we get that done, the goal is for you never have to call me again. You'll be on your own. You're good to go. You say, I know exactly what to do going forward. And that way I can take care of business on my own. And that's the way I kind of envision it. You go to Vanguard, you get their index funds. You get one of those, you get, a bunch of different things. You can even pay them. There are 30 basis points for their fees. Their managed accounts. I got no problem with that. And then you hire somebody like me or a financial planner to do the financial planning, because Vanguard's financial planning, Schwab's financial planning, Fidelity's financial planning is off the shelf. It's just completely rote, but they don't act like it is. If you look at the Vanguard sales pitch documentation, they say, we do comprehensive financial planning. No, it's not comprehensive financial planning. They know it's not. I know it's not. It's just they want to sound like it is. So it actually infuriates me. I had a guy, my man Billy Ray. Why did I push Jazz Wealth so much? Because they charge 1.5. Well, they don't charge 1.5 on accounts over 250. They charge, my man Dustin over at Jazz Wealth charges 45 basis points or something like that on accounts over 250. And I think it's absolutely reasonable. Absolutely. Does Jazz, Dust, know those guys do financial planning? No, they do investment management. I absolutely think separating the investment management from the financial planning, I think, is absolutely the way to go. And I just hope more and more people in the business do that. You can't do both. You just can't. You can't be investment management for a fee and do financial planning. You just can't. There's not enough time in the day to actually be looking at people's portfolios, to doing this, doing that, and all that. You just can't do it. And then on top of that, doing financial planning. A good friend of mine, who I'll introduce at some point, he just started his own firm. He's a CFA and a CFP. And I always tell him, I said, man, you got to figure out what you're going to do. You can do financial planning or you can do investment management. And he actually likes the investment management more. And I said, that's fine. I'll be happy to refer people to him because I trust him implicitly. And he charges a reasonable fee for investment management. But I told him, and I tell everybody as a CFA and a CFP, I said, you can't do both. You can't. You got to do one or the other. There's not enough time in the day to do both, unless you're explicitly stating that you're going to do passive investment management for a fee. I got no qualm with that. It's got to be explicit. And when I say passive investment management, my friends, I mean, you're just basically getting a good old-fashioned index portfolio, large cap, small cap, international bonds, whatever, and you're just making sure it stays allocated. I got no qualm with that. But you'd have a lot of these guys think they're not doing that. They're doing something more. They're not. All right. So that's the diatribe. What's your opinion on a 457 plan? Yeah, I just did a video on 457 plans. Currently maxed out my Roth. I put money in the 457. I just don't see the benefit of it, simply because at the end of the day, it's still going to come out as tax. You still have to pay ordinary income tax. Brian, I'm telling you, and this is, goes against all deferred taxes for as long as you can. No, man. If you're in a 12% tax bracket and you have stocks that are qualified dividends and long-term capital gains, you don't pay any taxes like a Roth IRA. You pay no tax on that. But Josh, you could put me in a 22% tax bracket. Yeah, I could. And then you're paying 15% on qualified dividends and long-term capital gains on any amount that's above the 12% bracket. So it won't be that much. It won't be. So what you'd want to do is you say, I'd rather have 15% long-term capital gains and qualified dividend taxes and have hardly any long-term capital gains and qualified dividends. So I definitely want an index fund, because index funds don't have a lot of turnover where they're sending you a lot of capital gains. I definitely want an ETF, an exchange traded fund, because there's some rules of the road that allows exchange traded funds to avoid sending you capital gain distributions on an annual basis. So in a taxable account, I'm getting an ETF, absolutely, as opposed to a mutual fund. And I'm getting one that doesn't pay much in dividends. So I shouldn't get hardly any capital gains. And I want to make sure it doesn't pay much in dividends. So it'd be like a growth ETF. A growth ETF would be ideal for a taxable account. So again, as you always look at your bonds or your Roth, would be your real estate investment trust, your large cap value stocks, your banking stocks, anything that pays dividends would be in a Roth. And your non-Roth account would be your growth stuff, your non-dividend payers, and there's certainly low turnover to that, hopefully no turnover. So that's kind of what you envision. You say, okay, my Roth, because it's tax-free, any taxable distributions I want in my Roth, so I don't have to pay tax on it. My non-Roth IRA, because it is not tax-free, I want to minimize any kind of taxable distribution. So you separate the growth from the value. Value, which again is dividends, generally speaking, that is going to be in my Roth. Growth, generally no dividends or few dividends. And again, we want to make ETFs, exchange traded funds, because there's not much turnover, not much capital gain generation. I want that in a taxable account. So the Roth can grow tax-free. Your stock account can grow tax-free. Why do I say tax-free? Because if you minimize the capital gain and dividend distributions, there's not going to be taxes or few. And then on top of that, when you go to your greater reward with the big guy up there, all tax-free to your heirs because of the step-up basis rules, which is wonderful. And there's no tax-free when it comes to a 457 or any kind of qualified plan. 5-year CD at 3% with one bump sounds better than bonds at present. I could not disagree with that. Do not disagree with that in the least, my man Jim. That's why I watch your video Straight Talk. Hey man, did somebody say the Straight Talk Express? Who was that? John McCain? Jeez. Straight Talk Express. All right. Let's see here. I missed somebody here. Prime money market is prime money market is 2.47 at Vanguard. It's tough to argue with that too, without question. It's 6 in one hand, half dozen the other. My man Jim talked about 3% 5-year CD, but you're all locking up your money. Prime money market is paying 2.5 roughly without locking up your money. No FDIC insurance on the prime money market fund. The days of money markets being stable at 1 are gone now. So in theory, we could break the buck. Hard to see that happen at Vanguard, but in theory it could happen. A CD, for a fact, is FDIC. So I would, it's 6 in one hand, half dozen the other. When do you need the money? I did a video the other day on the Navy Federal, I think, or Penn Fed CD, that if you break the CD before maturity, you lose 30% of the interest that you could have gained in that 5-year time frame or whatever it was. I was stunned to see that. That was a big deal. I was surprised. That's a lot of interest you're leaving behind. So if you're going to lock up your money for 5 years, if they have some kind of stringent surrender charges on CDs, then I'd go to the Vanguard without question. Just hear what we talking about. Just talk about financial stuff. My man, CP's information. Rifles at the ready. Advisor at our bank convinced us to use 50 cash and buy $200,000 life insurance policy that will build cash value. All right, this is going to freaking tick me off, Steve. All right, he's going to build. All right. Oh, man. This is a pet peeve of mine. All right, so my man Steve Brooks, advisor at our bank, convinced us to use $50,000 cash value and buy a $200,000 life insurance policy that will build cash value by 4% a year. All right. So, Steve, get an illustration and see how much cash value you have in year 5. See how much cash value you have in year 10. I'm just curious. We'll see what it is. So if you put $50,000 in there, and I'm not even going to do compounding. I'm just going to say $50,000 after year 5, because you have $50,000 cash value. After year 5, you take 4 times 20, because you got 5 years, right? So times 4%, that'd be 20%. So your $50,000 should grow to 1.2. It should grow to $60,000. If it's growing at 4% a year, not even compounding, just simple interest, that $50,000 should grow 20% of more than what you put in. I absolutely guarantee you're not going to have $60,000 of cash value after year 5. After year 10, that $50,000 should grow at 4% by 40%. So it should be worth $50,000 times 1.4. This should be worth $70,000. I absolutely guarantee you it's not going to be worth $70,000. So I would like for that guy who sold that to you to answer, you said the cash value is going to grow at 4%. How come after 10 years, I do not have $70,000 of cash value? And I'm telling you, I had a huge debate with a guy on the YouTube channel. The guy I was mortified. I mean, this guy was new to the business. And I was trying to be kind to him, but he was like saying, we're paying, it was Mass Mutual account. And he's like, Mass Mutual's paid 6.5% historically. So, okay, what's the cash value after 10 years? And it was less than what the initial deposit was. And I was telling this guy, I said, man, how can you sit there and say you're getting 6.5% when you said on the cash value? Because he said just like what you said. If I was getting 6.5%, then after 10 years, I should have whatever it was, almost double what I put in there. And it wasn't. It was worth less. How can you say that? And his whole thing was, well, because, and I know what's happening, is they have what's called a crediting rate. The crediting rate is 4%. That's what they're crediting to your account. And then they're coming right back out and they're taking 3 to 4 to 5% out to pay the commissions to the advisor, for the fees that they're charging, and all the other stuff that goes on. And so they're offering, it friggin' pisses me off. They're saying 4, 5, 6%. That's what we historically have paid. And you say, well, where's the cash value after 10 years? And the guy's like, well, you got to wait 20 years. I said, what's the cash value after 20 years? I mean, it's okay. It was, I don't know, 3% on average after 20 years, but wasn't anything like 6%. It friggin' ticks me off. And I don't, anyway, that's my thoughts. And the thing that makes me mad is there is a place for whole life insurance. There's a place for a type of thing that you're doing right here, where you're saying, I'm going to dump in $50,000. I'm going to have a $200,000 death benefit, and I'm going to get a long-term care rider on that as well. They'll provide me, $150,000 long-term care. I like those policies without question. But I hate the fact they're sold on some cash value accumulation that's tax-free. You can borrow against it, never pay tax on it. I hate that crap. It's freaking infuriates me, because life insurance has a place and it can be used correctly, but all the guys sell it incorrectly, either at ignorance or being nefarious. And I have to think a lot of these guys are doing it. Look, I'm not going to accuse anybody, but they should know better. Now, this guy who's on my YouTube channel is a new guy, and I'm telling you, he got trained from the life insurance agents how to sell it. I know that for a fact, because I've been in the business for a long damn time. But he was ignorant. He's just repeating back what he was told by the corporate titans for him to make a sale. And you make a sale on the sizzle. You always sell the sizzle. The sizzle is 6% tax-free or 4% tax-free. You never sell the reality, because no one's going to buy it. Anyways, that's my thoughts. The fact is, I don't want to say a bank at a bank. Yeah. If you're in the same tax bracket, Merck 850, while working and while collecting pensions, with your initial savings dollars towards retirement, you'd be best place in a backdoor Roth or 401(b). All right. So if I'm in the same tax bracket while I'm working and while collecting pensions with my initial savings dollars, I'm not following that question. In the same tax bracket while I'm working. So once I quit, I'll have the pension, and I'll basically be this equivalent of what my working income was. That's what I'm going to presume you're saying, Merck. In that case, I'd say it really depends on if you're married. Again, the whole point about being married is you're taking advantage of two standard deductions between you and your spouse, and because the tax brackets are higher. I mean, if you just look at the tax chart, married filing jointly, the first $19,000 is taxed at 10%. If you're a single taxpayer, the first $9,000 is taxed at 10%. And so anything above $9,000 for a single taxpayer is taxed at 12%. It doesn't hit 12% until anything over $20,000. So you want to take advantage of the two standard deductions in the doubling of tax brackets. So, which is the Roth. So in my opinion, take advantage of the married filing jointly and do the Roth. If you have a Roth 403(b), do it. I'm still not convinced on this backdoor Roth thing. I am not convinced that the IRS is not going to come down on that and say, oh, we didn't anticipate that. I mean, look, I get people want to do the backdoor Roth. I see that all the time in terms of the backdoor mega Roth. I'm not convinced the IRS can say, I could easily see that coming down the pipe. Then they're saying, nope, that's not the intention. So for me, until I see some PLRs, private letter rulings on the IRS saying we bless the backdoor the mega backdoor Roth, let's see. Joe Kraft. So this guy, Christopher, says, are you rich? And I am rich because I live in the United States, brother. So I'm going to, let's get this guy. Okay, I just stupid questions. Yep. I live in the United States. I am rich, and so aren't you. Joe Kraft says, wife says the ribs are ready. Thanks, Josh. I'll be viewing. See, what the hell, man? The ribs are ready. You're not going to freaking take a picture and share with us. My man Monty in Texas is here. Greg, hey, Josh, just received a tax bond book. We'll be reading it this weekend on a trip to Dallas. There you go. Maybe you go see my man Monty over your neck of the woods. Don't take out a loan for more than you can afford. Yep. Garland, Texas, right on. Did you end up buying your VTV? Actually, I haven't. I always keep forgetting to go and make the transactions. It's been sitting there in cash. I meant to do it today too. It's like, just buy the flipping thing already. I just, okay. I mean, I'm so damn lazy, man. I had the freaking Vanguard Target Retirement Fund for, I don't know, and I had 10% bonds. I was like, I hate bonds, but I kept it just I'm lazy. I don't like making transactions. So I sold it finally, and it takes a 2-day or whatever it is, the T+2 or T+1, I can't remember anymore, for it to settle. I said, all right, I'll just go back in there and settle, and I'll buy the VTV, and I haven't bought it yet. Nuts. Can I spell Garrett Financial? Yeah, it's just, I'm not top, it's just Cheryl Garrett, Cheryl Garrett. Well, let's see. What do you think about personal capital? Yeah, I got no problem with personal capital. The retirement stuff is pretty good. They didn't do a whole lot of tax plan though, Carlos. So I got no problem with personal capital. I actually get one of these days I'll do a better video on it because I do have an affiliation with them that if people use it through my website, I make $20 and you make $20. So one of these days I'll do a video on that to show you. And if you all like it, go through my website and pay me, man, pay me big bucks like Johnny Manziel. But no, I mess around with it. I like the retirement stuff. I thought it was pretty good. It worked. It worked pretty good. I liked it. The tax stuff was bad. But the retirement planning was good. I liked it. A lot of different methodologies for retirement planning, synopsis, but I was a fan. 41 with 280 in my 401k, 10-year return of 17%. I use a 10.5% return calculator. How accurate do you think they are? I use a 10.5% return in the calculator. Those big numbers freak me out and hard to believe. Yeah, I don't. Are you presuming, John, you're going to get a 10.5% return going forward? No one in the right mind would say that. And I'm not saying no one's going to say you're going to get 10.5% going forward. Well, Dave Ramsey, and he's not in his right mind for that regard. Dave Ramsey's in his right mind when it comes to debt. He's not in his right mind when it comes to investing. I'll use the Vanguard model, which I use my own financial planning software. 1% cash, 3.5% bonds, 7 to 7.5% stocks. That's what we use. 3%, 3% inflation, and that might be high because right now the trailing 10-year inflation rate is 1.6, but that does not take in food and energy. I think it's food and energy. It doesn't take into consideration on the CPI, food and energy, which is weird. But anyway, that's the way it is. So I use a 3% inflation, 1% cash, 3.5% bonds, 7 to 7.5% stocks, depending on international or domestic. 3% inflation, 2.6% cost of living adjustment for Social Security, because that's what the trustees report says. And so if you're going to use a different cost of living adjustment, you have to justify why you're doing that, because the trustees report says 2.6. And then use a 5% increase in healthcare costs as well. So Medicare grows by 2.6 or by 5%. Social Security grows by 2.6. So you can see there's becoming a bigger and bigger spread between the two. And that's because it's worst case scenario. That's because it's being on the conservative side of financial planning projections is what I use. So if I was using 10.5%, hell, we could all retire in the Bahamas tomorrow. I just retired and have 401ks at 3 different brokers. Is there a risk to put all funds in one account? So your funds aren't at risk unless, basically the only reason your funds would be at risk is if he stole. And then it's something called SIPC, the Securities Investors Protection Corporation, or something like that, SIPC. So I don't have any, people ask me this all the time. Should I keep it at Vanguard, Fidelity, and Schwab? Nah, just roll it to one. It's fine. If they steal from you, SIPC will cover you up to a decent amount of money. I can't remember how much. I think it's $500,000. If the firm goes bankrupt, you're fine. You still have the holdings in there. You still have the 100 shares of Philip Morris, 100 shares of Berkshire Hathaway. That won't change. Then you just got change custodians who actually custodies your money, who have actually the name of the account, the statement for that you get. So I'd have no qualm rolling into one. TSP funds, I like the life cycle, the most aggressive life cycle funds, and I would use a G fund as my cash bucket without question. I like the G fund for my cash bucket, and I like the life cycle. The I, the S, the C, the I, the S, and C. Yeah, so you get those life cycle 2055, 2060 funds, and then for 80% of the portfolio, you got 20%, essentially for 3 years of living expenses in the G fund. How tough to beat that, man. The TSP is fantastic. Fees are incredibly low. My biggest qualm with TSP, and everyone and their mom keeps saying this with the new TSP withdrawal accounts, it doesn't do anything for the beneficiaries. And off the top of my head, they got the BPO, the beneficiary or BPA. I can't remember what it's called off the top of my head, but the beneficiaries are still screwed when it comes to the distributions of the TSP. The withdrawals are horrible for beneficiaries. They have made it more liberal for the account owner, the person themselves, but for the beneficiary, it's absolutely atrocious. They haven't made any corrections to that. So for me, if I'm looking at retiring and I'm getting up there in age, I want to make sure I roll that to an IRA. I mean, the TSP, the fees are incredibly low, but nowadays I can get the fees just as low at Vanguard with ETFs without having the handcuffs put on the beneficiaries. I did a whole blog post on that and a bunch of videos on that too, because so many people are under the assumption that the TSP has changed it because that new law they passed that Trump signed in 2017. And it's better, but it's not, it's still leaves a lot to be desired. So a lot in Vanguard, Prime Cap. See, that's an active managed fund that's worth its weight. Prime Cap, they closed. I mean, when I was at Vanguard in 1998, they had closed that puppy. And then he came out and offered a capital opportunity run by the same guys. I don't know if it still is. I mean, it's 21 years ago. Every time the market takes a big hit, I increase my contributions from 10 to 13%. Man, no qualm with me on that, brother. Went to a new credit union for CD, 240 early withdrawal, 240-day early withdrawal penny versus my old CD, 700. Okay, so basically 9 months of earnings you'll pay to withdraw your money before the maturity. I use CSI funds. Yeah, there you go. Yeah, it's common stock, small caps, and international. Quincy, my man, says CSI. That's the way to do it without question. When it gets high, I lower it to 10 and then use the other to pay the extra. Yeah, right on, John. I like that. And Pops too says, thanks. That's what we're doing now. 40, 40, 20. Yeah. So you have 40. Man, I got no qualm with that at all, my man, Pop. 40, 40, 20. That's the way to go. 40% of the common stock, the S&P 500, 40% of small cap, and then 40% and 20% international. Yep. Whole life insurance is garbage. Get term life. Not necessarily, Kelvin. So I'm telling you right now, if you fund a whole life policy with a big part on the front end, that sucker can pay off big time. I'm telling you, it can. I've seen it with my own two eyes right here. The problem is with whole life is that the people who get it are generally younger and they don't have the cash to basically front load the premiums, the deposits. But I'm telling you, man, if you can front load those puppies with as much cash as you possibly can, people say, I don't want to mech it. A modified endowment contract. I get that. But man, mech isn't the worst thing that ever happened. It just means you can't borrow against it. And if you take it out before 59.5, you're going to pay a 10% penalty. It's like basically a mech of a whole life policy or a cash value life makes it like an annuity. All right. So you can't borrow against it. And there's a 10% penalty if you take it out before 59.5. But if the intention is not to take it out before 59.5 and you want it as a cash value that you can draw on later on down the road, say 30, 40 years, whole life can be flipping incredibly awesome. You just got to get beyond that hump. That once you start getting beyond the hump, the cost is always kind of on the front end. If you can hold back on that cost and fast forward 30 years, man, that sucker could be worth a hell of a lot of money. Growing tax-free, maybe it's got paid up additions, PUA. I mean, it could be fantastic. The problem is no one can afford it. I can't afford it in terms of how much you really need to put in there to really get that funded maximum. But I'm telling you, man, it's wonderful. It could be if you got the cash flow to afford it. It's incredible. No other way around that. The problem is most of us who can afford it are too old to get it, and most of us who can get it don't have enough cash flow to afford it as well. So with that said, I got 2 whole life policies on each of my children. So I got 8 policies, all with $50,000 each. So each of them has $100,000 total. They're 20-year pay. All right, that means after 20 years they are paid up in full, which means I never have to put another premium in there. So I think I put maybe $500 a year into each of them for each policy. Something I can't remember off the top of my head. But basically, what will happen is when they're roughly 25 each, they'll have $50,000 of paid up life insurance. And I don't know what it'll be at that point because I don't think USA has paid up additions, but I can't remember. But anyway, I do know there'll be I have Knights of Columbus that has paid up additions. So the Knights of Columbus with the paid up additions are pretty good. So when they're all 25 years old or whatever it is, They're going to have one through USAA, which doesn't have paid up additions. They're going to have one that does, and just paid up additions just adds to the death. It's a good thing. You want paid up additions if you can, and you want participating as well. But I'm not a life insurance expert. I've worked many of them, and I just remember what they told me. All right. So with my kids, when they hit 25, they'll all be paid up, never have to make another premium. There'll be a certain amount of cash value that they can use to do whatever they want. Ideally, they just let it sit there and just build and build and build. So by the time they're 60, and we're talking, it could be a significant amount of money. When I say significant, I'm not talking hundreds of thousands, but certainly tens of thousands of dollars that they can tap tax free. And on top of that, they will have at least $50,000 of life insurance for the rest of their lives. They don't have to do anything. I mean, even if they get heart conditions or anything like that, it doesn't matter. With the one at USAA, which is pretty sweet, they had a rider. I can't remember what it's called, but they could add up to 2 times the initial death benefit without evidence of insurability, which is freaking sweet. So I think they could add another $100,000 without ever having to be insured. They didn't have to go through underwriting again. So they have $50,000. They could add an extra $100,000 whenever they want. There's some restrictions on that. I think they have to be 40 years old. They can't be older than 40. And they'll be underwritten it's automatically underwritten. Now they have to pay for the extra coverage, but I'll give you an example. A good friend of mine that we used to do seminars, I've used this example before. West Point guy, don't hold it against him, but he went to Iraq and he was an NBC officer, nuclear, biological, chemical. And he was one of the phases where they went to that crazy case, the crazy Saddam's son or something like that. I can't remember, but he breathed in some chemical stuff that screwed up one of his lungs. So he could never get life insurance anymore, simply because he was uninsurable because one of his lungs was screwed up. But I can't remember the whole story. Kasai, one of the crazy son. I guess they're both crazy. So anyway, long story short, that was the impetus for him saying, you got to get your kids to have life insurance that has guaranteed insurability future. That way, if something happens to them, like what happened to him, they could add more insurance without ever being underwritten again, if that makes sense. And I said, that's a pretty good idea. And so we did that. So here's a guy who can't get insurance, and he's got 5 kids, and he lives in Louisiana too. So, Louisiana with 5 kids, and he's making money, so he doesn't really need it anymore. But if he, was happening on hard times, he would need that life insurance. But because he couldn't get insured anymore because his lung was messed up. And people say, what about Soldiers Group life insurance? No, stop. No. Do not go into Soldiers Group life insurance, because once you go from SGLI to VGLI, Veterans Group life insurance, friggin' premiums are through the roof. It's not an option. It could be an option, but man, you're paying a freaking crazy amount of money out of that. All right. Let's see. Would you recommend opening a Roth at a credit union or online like Vanguard? Not question. A credit union, they're probably going to put you in share certificates accounts. No, we want investments that can grow. Make that sucker grow. People should not invest at banks. Banks are like car salesmen. Let's see. Man, way down here. Okay, hold on a second. Banks are terrible to open an IRA. Prime Cap are good funds. Yep. An S&P 500 index fund or Fidelity Investments good. Yeah. What is Backdoor Roth? I'll do a video on that, Jim. It kind of makes my brain just hurt when I think about it. But essentially what you're doing in the basic scenario is you're contributing non-deductible money to an IRA. You can't take the deduction. And then, basically a day later or a couple of days later, you're converting it to a Roth. So basically you're saying, I cannot make contributions to a Roth because I make too much money. So I'll make it to a non-deductible IRA instead. And then I'll convert it the next day. That's a backdoor Roth. A mega backdoor Roth is you're adding all you possibly can into an after-tax part of your 401k. And later on, you're converting that to the Roth IRA. So I don't want to get into that, the mega backdoor Roth, because that's what I think has some serious issues when it comes to IRS guidance on that. The backdoor Roth, I put $6,000 into a non-deductible IRA, and I convert it, the next day. All right. So it used to be you wanted to wait a year to avoid the stepped transactions. I'm just not going to get all the stuff. There's tons of YouTube videos on that. no one really thinks you need to wait a year anymore. So you can put your non-deductible contributions to an IRA and convert it the very next day to a Roth if you want. No big deal. But the big deal is if you have other IRAs out there. So you got $100,000 in an IRA, and then you're going to open a second IRA with $6,000 of non-deductible contributions. You can't just take that $6,000 and put it all into a Roth IRA. It doesn't work like that. They have what's called the aggregation rules. So you got your $100,000 IRA, and you got your $6,000 non-deductible IRA. You got to get a percentage of this amount right here, which in that case would be 6%. 6% of the $6,000 you put to the Roth would be tax-free. The rest would be taxable as a conversion. There's no way you'll be able to understand this, just me yapping on this, but it's one of those things I guarantee it's going to catch a lot of people off because they don't know about the aggregation rules. And because they don't know about it, they're doing these non-deductible conversions, the IRA contributions, converting it over to Roth and say all is hunky-dory. And then they're going to get audited and the IRS is going to say, oh, Jim Bob, did you do the aggregation rules? You're going to say no. And you're going to say, what the hell is that? They're going to say, yeah, we need all the paperwork. You're like, oh, why did I bother? So let's see. Was Backdoor Roth as a rule, our family never borrows money? Yep. What's your favorite? Oh boy, do I don't even. Let's see. So you sold out 98 stocks because I'm freaking too lazy. Yep. Quincy, thanks, bud. Thanks for reminding me. How's the show, man? I'm getting MRI next week. I was just watching my man Flemlo Raps, who got great videos on football. Flemlo Raps. I interviewed him for my YouTube channel, and he had a shoulder issue too. It just, man, it hurts like hell. It's getting worse. And so basically, I'm getting my MRI, and I went to the doc, and because I have real life insurance now, and the guy's like, it could be just your joints are pissed off at you. You might get something wrong in there. We got to get an MRI to see. So I'm getting it next week, and I tell you, it sucks, man. I mean, I can't sleep very well at night. I certainly can't lift weights. All I do is squats now. I was doing some deadlifts the other day. That didn't hurt so bad, but it's not right. It sucks. When part of your life consists of being and exercising, it's an addiction to you. And the idea of not exercising is depressing. It really is. So at least I can do squats, but it's not, I mean, that's fine. I love squats. I literally hate squats, but not be able to freaking just do basic presses. Thanks for asking, Greg. What would the IRS do if they decide the backdoor Roth isn't kosher, apply a retroactive? I think it'd all be grandfathered rolling, but look, man, that's just my opinion. Doesn't mean it would be. I bet they would either say they grandfathered it, or they're going to say, you got to pull back out and you're going to have to show the paperwork. It's just a pain in the ass. I mean, anytime you're dealing with the IRS, who wants to deal with that? I just don't. It's kind of like these people spend all day looking for every single tax deduction. I'm like, man, it's going to save you $3. Just pay the stupid tax and be done with it. Margaret says, since you don't like bonds, would you put in a high percentage of 529 and keep a all right, so 529s are different, Margaret, because we're going to need the money soon. So the answer to that is I would. So anytime I need the money soon, the bonds are the alternative without question. Ideally CDs. I mean, there's no other way around it for me right now, as we say here, because CDs are such a value relative to bonds, but you're not going to get CDs in a 529 plan. So I always like the age-based one, 529s, Margaret, the age-based plan. So if your kid's 16 years old, he'll probably have 85% bonds and 15% stocks, if even that, and I'm very fine with that. The age-based one for sure. Good goal. Let's see. Late, freaking Jeff Rains, man. What's up? I'm going to have to charge you a late fee here, man. Glad you're here, man. Regarding the kids are in college. Oh, all right. So Margaret says kids are in college will be using ESG next year. Put all that sucker in cash. Get out of stocks ASAP. Not a lot of smashing going on. Smash. That's right. My man Bruce up in New York says smash the like button if you like what you see. I get that from that man Graham. That guy Graham cracks me. Graham Steppen. You ever heard of that? You've watched that guy? He has these little things like, and I'm going to tell you what to do. Smash the like button. It's pretty funny. I always forget. Smash away. Real quick, why they say smash is because YouTube algorithm, just while I'm yapping here, appreciate the heads up, Bruce. The YouTube algorithm loves activity on your channel. So they look at three things in particularly. obviously they look at how many people watching it, but they look at the longevity of people watching it. So if people watch longer, YouTube likes that because they can sell you more ads is what it is. Literally. I mean, you think about it, if you're going to start a YouTube channel, think about it in the context of what makes YouTube money, how you build your channel. YouTube likes long videos. They like this live stream stuff like we're doing here. And they like people smashing the like button, and they like lots of comments as well. So that's why, man, comment below. And you notice I try to comment as much as I possibly can. I guarantee I miss a lot, but I try to comment because A, I enjoy communicating with the folks who took the time to comment. But B, it also makes me look good in the eyes of our YouTube algorithm overlords. And I want them to look good. So they send this more people out there, and more people get to see old Josh. More people buy my books. More YouTube PPC advertisement, and hopefully the more lives I can change with some basic common sense financial planning, which seems to be few and far between, that's for sure. My man Pop Stu says, "You the man." Thank you, sir. Is a traditional Roth converted to a Roth IRA heavy in taxes? I mean, it could be. It depends on what your tax bracket is and how much you have in there for sure. Absolutely. I've heard rolling over your highest point without going to the next tax bracket per year. Yeah, Quincy, man, I get that. I just, at the end of the day, look, if you go up $4,000 to the next tax bracket and you're only paying $4,000 in the next tax bracket. So all these people say, we want to do whatever we can to stay in the 12% bracket. All right, well, I just have $4 extra $1,000 of Roth conversions that put me into the 22% tax bracket. All that does is I got to pay 22% on that $4,000. I mean, that's a big jump. Don't get me wrong. It's a 60% increase from 12 to 22, but just not that big of a deal. Don't sweat it too much, I guess what I'm saying. If you see the benefits of the Roth conversions, well, hell, take the benefits. And even if you go a few dollars into the next bracket, don't worry about it. Kelvin, term life is half the price for the same cover. I bet term life is a lot cheaper than half, my man Kelvin. I bet term life is probably an eighth of the coverage of whole life for sure. Insurance, yeah. I mean, this thing with whole life. I mean, the issue with whole life is bonds. I mean, it's literally you're buying bonds, but they're bonds that are tax free. And so if I'm making the argument that I can get 30 years down the road a whole life insurance policy kicking in nicely that pays me a decent after-tax yield, that's great. But then my argument is, well, I expect stocks to do even better than that. So the answer, I 100% agree with it without question. Buy term and invest the rest. I completely agree with that. But at the end of the day, there is a room for whole life that I think a lot of people miss. And one of the rooms is it can be a very safe place well into the future now to get some decent cash value growing tax-free. With a death benefit, that's tax-free as well. Let's see. When my name is okay. At least you took my man Sailor says my sister lost $30K in a small business. Whatever happened with the water leak in my basement? Oh yeah, man, Big A. Yeah, I got a guy. One of my friends is gonna come over, and we're gonna do the fix the drywall. Is it drywall? I can't remember. It's nothing. It wasn't a big deal, thankfully, but we got to get that fixed. It's just one of those things that, time just goes by. Other emergencies, that's for sure. But thanks for asking. That's, man, it's crazy. Remember that. Lifting weights is therapeutic, man. 100% right, my man. 100%. What are your thoughts on? Yeah, so now we got one. What's my thoughts on permanent life insurance as a bond substitute in a retirement portfolio? I mean, I like it. I do because it's tax free and you have access to it via loan. I'm a fan, but it's got to be structured on the front end. I'm just telling you, Vaughn, so many people don't structure it properly on the front end. You got to have the money. If you're going to use whole life or a permanent life, cash value, UL, universal life, it's imperative to front load it as much as you possibly can on the front end without question. And if you're going to borrow against it, tax-free, as all these guys say, you got some limitations how much you can front load on it because of MEC rules and modified endowment contracts. And so I like it without question. Just I have seen very few that are properly structured. Very few because it's expensive. No other way around that. My man Phil says, my mother's 85, Texas residence with $300K paid off home. How's a best to pass his property on to me and 3 siblings at her death. No other way around that. Step up basis. You won't have to pay anything. Do not retitle it in your name, for the love of Mary. Make sure she does not add any name to the title. It's a gift, and it would be subject to a gift tax. No, you won't have to pay a gift tax because you have such a huge gift tax exemption, but you'll lose part of the step up basis. So Phil, no matter what you do, make sure your mom is the only person on the deed, the title, the deed. No one else gets added to it. But Josh, what if she, I want to avoid probate? Well, go down to the county office and say, how does she avoid probate? Is there some kind of transfer on death form? Is there some kind of quit deed, something she can do in order to avoid probate? Probate is not the biggest deal in the world. It happens all the time. Just whatever you do not add as an ownership where she adds somebody to the title or the deed. Oh, I cannot tell you how many people have done that. Horrible. Right on, Bruce. Bruce says, I'm worth it. All right. We keep our investments very clean and simple using equity mutual funds and money market. Yep. How's the pricing on Charles Schwab mutual funds work? I don't know, man. That's they have so many different funds. You have to look into it. I'm not sure. With your 2 bucket system for retirement, how much does that market need to go down before you start using your cash bucket? I would use my cash bucket on the front end. Absolutely. So I'm not touching the stocks at all until that cash bucket is exhausted, Kenny. So the cash is what I'm using first, if that makes sense. The whole point about that is we want to avoid the negative sequence of return risks. So we got the cash over here and the stocks over here. If we're taking it from the stocks when the market's fallen, that's bad. You can't recover from that. So we want to avoid that by taking it from the cash account. Now, some would make an argument. I actually think it's not bad. If the market is going up, pull it from the market. Absolutely. Take it when the going is good. Take the gains off the table. I got no qualm with that. None whatsoever. The issue is we don't want to sell in a declining market. We got to avoid that at all costs, which is one of the reasons why reverse mortgage can be a wonderful place as a park to tap into. In fact, I did a video on that where they studied it. They say you have a reverse mortgage as an emergency asset. So when the market's declining, you don't have to pull out of a declining market. You can take it from your home via the reverse mortgage and then let the markets recover and then stop taking from the reverse mortgage. And instead, at that point, taking it back from the market. I 100% makes sense to me. And that's exactly what I plan on doing. Thank you for your answer. You got it, Juan. Hope that helped. Pay for a home is amazing to have. Yep. I cannot agree with that more. Thoughts on using VA medical as a healthcare bridge for? Yeah, absolutely. I got no problem with that at all. The only thing I'd say, Mark, is with the VA, hey, Mary, see you mañana. With the VA, you just got to make sure they accept your TRICARE. That's all. I guess you're using the VA, so it doesn't matter. Had a good friend of mine down here this way, and he went to a regular hospital, and they basically treated him worse than a Medicaid patient, which is nuts because he was a combat vet injured in action, and they treated him like he was yesterday's news, or his wife, because it was in Atlanta and there was no VA hospital around, so they moved to Florida to be near the VA. So I got no problem whatsoever with it. Bond alternatives I hate to keep asking about the bond thing. Bond alternatives of 401k. I like a stable value fund, Jeff. I mean, stable value funds are for me just because there's no downside, without question. I mean, the thing with bonds, you're not making any money. The risk is if the interest rates go up, the price of your current bonds goes down. It can go down substantially. I mean, everyone acts like, I showed you the chart that doesn't look like it goes down that much. This is the red for bonds, and this is the stocks. So relative to stocks, it doesn't look like bonds go down that much, but they can. I mean, we're talking 10%. Some of these guys go down 10%. That's a big loss. A stable value fund should not have that happen. Rexpo's on here late. UNCB, too busy cleaning rifles after range day. Cleanliness is next to godliness. Yes, sir. Yes, sir. Oh, yeah. You guys got to be on time, man. All right. When the market goes up, do you take the money out from the stocks or replenish the cash? Yeah, that's what I think. Big A. Yeah, when the market goes up, take the gains off table and replenish the cash bucket. Yep, 100% right. Yep. Good stuff, guys. Looks like we're done here for the day. So I appreciate y'all being on board. It's like I said, I enjoy this. YouTube enjoys it. It looks like I'm able to answer some questions and hopefully give you some food for thought. I am going to do this one tomorrow on Ned Faber's Trinity portfolio, which I actually like a lot. He's got a lot of good charts in here, which I think is pretty neat, actually. I'm going to do a video on that. And I got another one to do on what did I do with it? Another chart. I can't remember. I got another chart here to do. Forgot what I did with it. Anyway, so I got a couple videos I want to do tomorrow. I can't find it on various things. So if you got suggestions, put them in the comments, man. Without question, I followed your homework assignment, watched your video, and saved me $600,000. But I'm still struggling with converting to Roth, but paying taxes out of the traditional IRA. Yeah, I get it, man. That was my man Mike who came up with that idea, and he's an engineer, or I don't know if he's an engineer, but he's a math whiz by trade. So. If he's convinced, I'm convinced, but that doesn't mean you got to be. That's for sure. I look, for me, Rex, I'm like, do I really want to see my portfolio drop by the amount of taxes? And the answer is not so much. But what if you don't have the cash? What are you going to do? So right on, man. Right on, Joe. Love this live video. Yeah, I'm going to do it once or twice a week. I like it. I have fun. But I want to do one during the day too, like on a Saturday or something like that. Once my kids are done with their after school activities, we'll go on a Saturday afternoon. It seems like some of the audience can be on the Saturdays and some are at nights, but I do enjoy it. And I thank you guys. And Ben says, how difficult is to switch from a saver to spending? That's, you guys can't see it, but I got a tab up here for a video I want to do where they actually done research on that, literally research on decumulation and what happens, that it's a whole different ball of wax. Which is, real quick, why my whole pet peeve with the financial planning industry is all based on accumulation. Accumulating. We got to accumulate. Screw that. When it comes to taking money out and you're paying 1% and you're saying, I can take 4% a year out, you're taking 5% a year out. It's a whole different ball game here. It's a whole different ball game. It's not just, you're taking money out instead of putting money in. It's also the mental. You're seeing the portfolio drop in value. There's an emotional thing that is tied to that. They've done studies on, which one of these days I'll do a video on, because I find it incredibly enlightening. The difference between tapping in principal and adding to it is two completely different mindsets. And the financial planning industry is still on the accumulation mindset. We can make you more. And the vast majority of people who have the money that the financial planners are going after are looking at a whole different paradigm. They're saying, I've already done all that. Now I got to make sure I don't run out. Yeah, right now. My family's waiting for you. All right. See you guys later. Thanks, y'all. We'll see you, man.